see the screen. Let us start now. Good evening, everybody. I want to believe that we had a very great and long holiday and rest. I'm asking us. I want to believe
yes, we do.
Okay, so great. So it is time now to work. Okay, so I think last time that we met, we stopped around something like audit procedure. Is that correct?
Yes, sir.
Okay, so we are going to continue from there. Please let me be hearing our response so that I will know that we are together. If not, anywhere you want me to pause or come again, please let me know. It's important to what we are doing because of network. The network may be good or bad around my area. I believe that you are hearing me. Meanwhile, you are not hearing me again. Okay, so
All right, sir.
let's quickly go over the audit procedure so that we continue from where we stop. So when we are talking about audit procedure, it's an aspect or even critical aspect of audit methodology and gathering of evidence. If we want to gather audit evidence, we must put procedure in place. And part of procedure that we must put in place, I actually pinpointed some that we should not forget them because they can easily, their definition can easily get off from us, if I can use the word. That is reperformance and inspection. And I told her that when we are talking about reperformance, we are talking about process. Reperformance deals with process, ensuring that the process is the way they've told us it is. From the point we are planning, we've done our flow chart, that is, or a record of the workflow in our client's office. So now we want to try to see if what they said this is the way they are working is actually the way things are actually being done in their office. So we do the performance. So we select a process. It could be sales process, it could be procurement process, any process, and we follow it through. Then we say we are performing. Also, inspection, so that we will not mix inspection too with observation. I said the difference between the two of them basically is the level of our involvement in it. Because when we are talking about observation, we can easily observe just looking at some things and put something down. We look at activity, maybe stock counts, and we put some of our observation down. But let's say we are to inspect, it's going to get us involved. That means we have to pick some items, select some item, lift it up, look critically at it. Is there any damages? Is there expiry date? Is there, it is an inspection that we know all those details. But when we are observing, we are not that involved. But when we are inspecting, we get involved. Because like now, we can say we are observing because every one of us, we are in different environments. But somehow we know what is happening now. But if we are inspecting, we get more involved. We must be there. Our presence must be felt. So those are the differences that and key aspects of audit procedures or tools. I used to tell us that we should see it as a tool. Should in case exam comes out in such a regard, see audit procedure as a tool in the hand of auditor that we must use to gather audit evidence. So I mentioned those ones because there's a way they can be tricky in the question as regards the performance, inspection, and observation. Okay, so we move on to assertions and letter of representation. Assertions and letter of representation. But before we move on, let me hear us. Is where we stop? Is it clear? Is there anything you will want me to say more when it comes to audit procedure? That was where we stopped. Please let me just hear from us, maybe by chat or just unmute and say one or two things, so we know that we are together before we move to letter of representation and assertion.
It's clear.
Okay, Farouk.
Yes, sir.
Okay, great. Okay, great. So let us deal with assertions and letter of management representation. I'm trying to scroll up. I hope I can easily see them. A moment, please. So when we are talking about assertion, while I scroll, when we are talking about assertion, we are talking about management directors confirming to us, assuring us to the best of their knowledge about the year we want to review. And this is critical part of their responsibility. When it comes to audit, they must give us their assurance, and the assurance must be in form of writing, and we call the medium through which they use to address us management representation letter. And for the sake of our exams, they may not tell us that it is management representation letter. They will just ask us, what is representation letter? What is representation letter? Please, we should know that is the letter of correspondence or correspondences exchanged between us and the management of the organization, originating from the management to us, confirming to us and giving us level of assurance in some critical aspects of the business and of the financial information presented to us. So areas of assertion, critical areas of assertions that they must assert or give their word as regards it. Number one, they must give assurance to us in form of completeness of the information. That is assuring us that nothing is missing in that statement that they are presenting. Every transaction during the year, let's say last year, they were all recorded and presented to us. Don't forget, it's the legal responsibility of management to prepare financial statements or have a financial record. Even though we are accountants and usually we are the one that we prepare it, but we prepare it on somebody's behalf, on the behalf of the management. The legal right and responsibility belongs to the directors to ensure that the organization has a record, financial record in particular. So we are like medium used to get it done, but they must own it. That is, it's their duty and responsibility to prepare the record. So they must assure us of completeness. They must assure us of occurrence. And what do we mean by occurrence? Maybe I should quickly go through the points, should in case we have one or two among us that are jotting where we are. So when we are talking about assertion we deal with completeness. They must assert on occurrence. They must assert on accuracy, they must assert on classification, they must assert on understandability, they must assert on valuation, they must assert on right and obligation, they must assert on the existence, that is existence of assets, and last but not the least, they must assert on cutoff or cutoff period. So let us take it one by one. We've dealt with completeness. So occurrence simply means that everything presented actually existed, and that there is no item in that record that is fictitious. Every record, every presentation in that account actually existed, and there is no fictitious figures or items that they put in the financial statement. That is what occurrence actually deals with. Then when we are talking about accuracy, to the best of their ability, they believe that it's error-free in form of calculation, grand total, and the like. So that is what accuracy means. And every aspect of assertion is actually an audit aspect. I think I should point that one out. Every aspect in which the management asserted are actually audit areas. Why? We want to confirm that everything that they've said as regards the business, as regards the financial, they are actually the way that they said they were. So it's an audit area. Every assertion is an audit area. So accuracy, everything recorded is recorded accurately. No missing figure, T crossed, I dotted. Then when we are talking about classification, we are talking about items that should be on the debit side are actually classified to be debit. Items that should be on the credit are classified to be credit. And even though they are credit too, credit could be different. Income are credit item, likewise creditor. So they must ensure that they did not put post income as creditor. So that is proper classification. So when they assert or assure us of proper classification, that is what it means, that as much as possible, they've recorded income as income, expense as expense, creditor as creditor, and the like. Understandability, which relate directly with classification, because if the classification is not properly done, then understandability, the financial will not have understandability. If they've put creditor as income, creditor's figure is appearing as income. The issue now is we take the creditor's figure as part of the income. So understandability is lost. And because they've put creditor as an income, it's going to be taxed too. Like we are going to put VAT on it, which ordinarily should not have put. So that means the organization is losing money. So proper classification will ensure understandability. And where proper classification is equally lacking, understandability is inevitably gone. So we'll talk about valuation too. They must assert and assure us about the valuation of assets. And after they've assured us that the valuation is properly done, like let's say they have forex, is properly classified as at the year end or as at the date they are reviewing, or let's say they have property, is properly classified. Maybe they have stock that is on Nigerian Stock Exchange, is properly classified. We are not talking about stock of maybe work in progress now or cost of sales. All those valuation, even some stock that we sell too, if they need proper valuation or evaluation, they must ensure that they do it and assert to us that it's been properly evaluated. Right and obligation is another aspect of assertion that they must assert to us. So right simply means they have rights to own property and to assess the property that the organization has in the record. And one of the ways that we must ensure that is to visit those locations to know where the assets are and the like, and that they can actually assess it. An obligation deals with those aspects that they've enjoyed, but they are yet to be paid for. Those items or those privileges that they've enjoyed, those services they've enjoyed, but yet to be paid for are obligations. So when they assert on this, they are telling us that everything that they've enjoyed yet to be paid for are actually put in the record. Assistance deals with, especially when it comes to assets. So assistance, by the time we want to audit assistance, we ask for something like list of or asset register, which will show us the net book value, show us the location, so show us the quantity of the asset and the like. So to ensure that we agree that they actually existed. So we can now pick some from the list and say we want to do physical inspection. By that time, we will not do observation. We say the procedure we are going to use is physical inspection. Cutoff or cutoff procedure deals with the beginning and the ending dates chosen by the organization for the report. So we say the accounting reporting dates. That is what we mean by cutoff date. Okay, so let me hear from us before we move forward to analytical procedure. Let me just hear from us.
So I think you should just maintain.
No, I could not hear Farouk. It was okay, Farouk, what did you say?
Yeah, no, I was thinking if it's going to be fine, if you can just maintain the screen to where you are currently, because I don't know, I couldn't catch up with some of the things you were saying. I'm actually looking at the screen, but I couldn't read along code.
Okay, yes, because actually I was lecturing, giving the lecture from my head because it was not easy for me to locate, but eventually I find it now. But we are through with the page. So I will move on to analytical procedure. I could see it now too. Yes, so the screen now will be maintained now. So do we have any other comments? So we can move on to analytical procedure. So as part of audit evidence or gathering evidence before we can give our independent opinion, we must ensure we analyze. And analysis comes both at the beginning and at the end, even at the execution stage of audit assignment. So at every stage, we must analyze. When we are planning, we must analyze. Let's say, for example, we had an audit last year of the same client. So we must analyze what has changed, even at the planning for the current year. We must analyze what has changed between the time we left them and now, and put it into consideration by the time we are planning for our audit. And when we want to plan for the audit class, what do we use? Which documents we use to communicate internally when we are planning for an audit? So I would like to have an answer. If not, I should quickly deal with it before we move on.
So please, your question again.
Okay, the question now is this. At the planning stage, when auditor plans, there is an internal document that we must have, which will contain an aspect of our analysis. I said, what is the name of that document? We've dealt with planning before. I just want to be sure that we've not forgotten what we've spoken about, I think 2 weeks ago, because we are now building on all those premises.
think audit planning memorandum.
Okay, thank you. Audit planning memorandum, which we can equally call now audit strategy memorandum. Okay, so inside it we must plan and we must do analysis. So we use audit strategy memorandum, ASM or APM, audit planning memorandum to plan and communicate to the audit team. So we must do analysis too. What has changed between last year and this year? Even the trial balance they give us for the current year, we must analyze what has changed between their last year's sales and this year's sales, expenses, income, gross profit, and the like. We must ensure that we analyze so that we know how to go about the audit. And even we must analyze so that we can know and do our risk assessment. So analysis is very important. So what can we say analysis really is? Simply is, we can say is making sense of the figure. Making sense of the figure. Yes, here. When we want to make sense of the figure, we need to analyze. We say figures don't lie. That's true. But figures can hide a lot of meaning if we do not analyze it. We need to analyze as auditor. Let me give us an example. If we do not analyze, last year, let's say our clients, last year our client made a sales, let's say profit last year of 10 million. This year too, relatively 10 million. So on the face value, say as an organization, we are doing well. But by the time we begin to analyze and ask some critical questions, last year when we made the same relative figure, what was our capital injection? What was our capital outlay? Now that we made relatively the same profits, what was our capital injection? What was the capital outlay? Let's say, for example, last year, by the time we made 10 million, we made 10 million, but we use our capital, let's say around 10 million too. 10 million give us another 10 million. But let's say this year we use 15 million, and maybe as a result of COVID or whatever, we made relatively 10 million. So the truth of the matter is we performed better last year than this year when we compare return on capital invested. When we analyze based on return on capital invested, it's now clear that return on capital investment was better last year than now. So we need to analyze. I think somebody needs to mute. I could not see the person now, but we are hearing underlining. So please, if you are the one, help us to mute so that everybody can enjoy what we are discussing. So we make sense of the figure by analyzing. And also it's important to let us know that when we should not, analysis is not major. Audit is the major thing we are doing, but analysis is important. So we say analysis is supplementary to what we are doing. Why are we stressing that? Like in music, they say the major or minor. If somebody major or minor, you know it's an issue. Minor will always be minor. That is something that is a bit less in importance and something that is critical. So supplementary or analysis is assisting us to have a good audit. But it's not the only thing we must do in audit. So it's supplementary and it makes sense of the figure that we've audited. So it's a tool on its own too in gathering evidence and enriching our conclusion and independent audit opinion. And when we are analyzing, we will be talking about comparison. We compare last year against this year, or maybe the past 5 years that like we usually have 5 years financial summary. So we could have that. So we are comparing, just like our IAS 1 dealt with it, that's presentation of financial record. So in the presentation of financial record, it is mandated that every account must have last year and this year. That is analysis to compare. So we can easily see at a glance the differential. It is important for analysis so that we can interpret very well and have understandability of the financial statements. So when we are analyzing, we compare, and if we are not comparing, we are looking for relationship between figures. So when we are talking about relationship, we'll be talking about what relationship does sales have when it comes to gross profit. So we say we are working on sales turnover. I want to believe we know all that. Sales turnover. So that's the relationship between the sales and our gross profit. Sales turnover. Yeah. You can say, okay, we want current asset ratio. Current asset ratio. So that is another relationship. So that simply is telling us we want to know to what extent is our liquid asset, current asset, carry us against our current liability. That is, asset that we can easily gather or sell and make money of within a year against monies or obligations that the creditors can call for their money within that same year. And relatively on the field, it is believed that such a ratio should be ratio 2:1. That is, we should have double of our liability as an organization. So when we are doing that, we are finding relationship between figures. So in analysis, we are not finding relationship between figures, we are comparing them last year and this year, or we are finding a relationship even between this year and this year. We can find relationship too between last year and this year, depending on what we actually want to achieve. Okay, so any question about analytical procedure before we move on? I hope I will be able to scroll up now since my screen is a bit, but let me hear from us. Let me hear from us, please. Analytical procedure.
Hello, sir.
Yes.
What is the difference between the analytical procedure and the supplementary?
Between analytical procedure and the supplementary.
Yes, sir.
Okay. Who is speaking? Who is speaking, please?
Jide.
Oh, Mr. Jide. Okay. So
yes, sir.
When we are talking, there is no difference because it is in analysis that we will be talking about supplementary. So
Okay.
when we say analysis is supplementary, it's a relative word. We are telling us that it is supplementary to the real audit.
That means that
that is assisting.
They are more or less okay.
It's assisting, it's aiding our audit work.
They are interwoven with each other.
Yes, but what basically what we are saying is, let me use this example. We eat food. When we eat food, that's the real food, Abby. And they say the real food is the drug that we should use as human being. But at the same time, we have vitamins, and we call them supplements.
Hello?
We call them supplements.
Hello?
So,
hello, sir.
Yes, we are together. Please help us on mute. We could hear you, but for the sake of others, we've heard your question and I'm dealing with it. So when we take food, that's the real food and that's the real drug. But we take our vitamins too, and we call them supplements. That is, should in case the real food that we are eating will not assist. Oh, I think my internet has gone off. Hello?
I'm here, sir.
Yes.
Okay, you can hear me.
Yes, sir.
Oh, great. So let us continue then. I think Zoom may soon log us out. I think that is what is happening because I received that notification. But so far you can hear me. Let us continue. Let us continue so far you can hear me. Okay, so I hope we understand supplementary and analysis now. Okay, so let us move on to related party. Related party in audit. So when we are talking about related party, we are talking about transactions or associations. Can we hear me? I could hear echo. Please let me hear us before I continue.
Yeah, the echo. We could hear it too, sir.
It's echoing, right?
Yes, sir.
I'm coming. Can you hear me now? Can you hear me now?
Yeah, I think it's fair. I think it's
better
fair.
now.
You can continue, sir.
Aha. Okay. Okay. So when we are talking about related party in audit, we are talking about an aspect of audit evidence that we must gather as it relates to different association that our client has with other organizations. It could be their associates, it could be their, what do we usually call this? If it's not associates, like minority interest, okay, subsidiary. That is the word I'm actually looking for. Yes. So all those relationships and some that they will not actually disclose and we may not easily be able to verify. So as auditor, how are we going to gather information about them and ensure that we audit them? Identifying related parties and related parties transaction. We should not forget one thing, that primarily every transaction should be done at arm's length. Every transaction should be done at arm's length. So when we are not talking about related party transaction, so it simply means we need to take care because some transactions may not be done or executed at arm's length. That is basically what it means, and that is the area of risk when we are talking about related party transaction. So as auditor, we need to carry out a review, and please class, let us pay attention here because I'm going to give us the approach to it for exam purposes. We will see that, let me quickly scroll and see. We are to obtain as auditor the list of relationship that our clients have with other stakeholders that could influence transaction. But the truth of the matter is this. Yes, list of related party transaction. Can we see my scroll? Can we see the cursor? But the truth of the matter is when we are auditing and on the field, we may not be able to obtain this as our when due, if at all we are able to obtain it. And even in the exams, by the time they create different scenario for us, it may become a bit confusing because our financial reporting experience, in which we talk about minority, we talk about majority shareholder, we're talking about 51% and the like. And by the time they trick the question, we may actually lose what we should actually focus on in form of related party. But this is how you will know whether there is a related party transaction or whether there is a significant party in the transaction or not. We should look for influence. Influence, influence, influence. Who influence what in the organization is what we should actually look out for in the scenario they will create for us. Because it is possible for a majority shareholder not to be able to influence some transaction that even some, like minority interests, if we can use that word, to influence. So let me elaborate more so that we can understand. What I'm saying is this: even though stake in an organization could be a big deal, but influence could be more big deal. In this sense, it's possible for a shareholder with 20% interest in our client, while maybe our client itself has 80% in itself, but that 20% shareholding or shareholder actually could influence seriously the person or the organization that has 80%. So what do I mean? If, for example, the major sales, major contracts, major business relationship actually is coming from that relationship that has 20% or even less, if we observe in the scenario or in our client's office that if anything major is going to happen, the director in that organization, should we say little organization, we can use that word, must sign or consent to it. And if they do not sign or consent to that transaction, it does not fly, then we are talking about a significant influence, a related party with a significant influence. So if we take a look at it from the angle of minority, majority shareholding, 51%, this percent, we may lose focus and we may lose the track of who actually is influencing what and who actually is related. Because it's equally even possible that they may not even have like shareholding like that directly, but indirectly they so much influence and they are already more or less part of our client's business, that if they should go away from that organization, that business could crash or collapse. So those are significant parties. Those are related parties that as auditor we must look out for, because at the end of the day, it could be going concern issue. And we are today, we should still get to a point that we do audit of going concern. So related party could lead to a going concern if not properly audited. And we cannot audit those transactions if in the first place we do not know that related party actually exists. So we must be able to identify them, and telling us that the major factor to look for, whether in the exam or in the real life, is influence. Look for influence. Who influences what? Which organization influences what? Who must partake in something major before it can fly? Whose consent, if we could not get his consent or the organization consent as a whole, something major will not happen. So those are influences that as auditor, we must ensure that whether we were given the list of related party by the management or not, we must ensure that we take a look at it and understand the relationship and ask questions and actually audit it very well by verifying every aspect of transaction that they must have conducted or that has gone between them, that has happened between them rather. So that is related party transaction. Please look for influence. And I assure us of one thing, we approach that question looking for influence. We cannot miss it. We cannot miss, no matter how tricky the question will be, we cannot miss it. So I'm going to pause here while I allow feedback from us too before we continue to other subtopic, refusal of management representation letter. That is, if management will not present what they're supposed to present. So are we together, please?
Yes, sir.
Okay, great. Any question
Sir,
on?
I have a question.
Oh, great. Please ask.
Yes. So you're trying to say that related party transaction is based on the influence in the transaction. So you're trying to say, sir?
No, I'm not saying it's based on. I'm saying that the greater, the easiest, and the way that we cannot miss out on the trick that they are going to play on us in the scenario in the exam is to look for influence. Don't forget, in our FR, we'll be talking about 51%, 21% Abi, 5% and the like.
Yes.
So as a student of accountants who could see that there's a company with 5%, we may neglect it. We may neglect it and say the relationship or related party is not that strong, and we are looking for the 51% at the line. Meanwhile, that 5% in that scenario is actually the more or less the backbone of that organization. So you will leave that organization that has that 5% and treat it lightly. At the end of the day, is going to cause a big issue. And that's why I'm pointing our attention to influence. So I'm not saying it's based on it, because on the understanding of accounting, we'll be talking about minority interest, maybe anything 20% or less, majority shareholding 51% or less. Those ones are standard and we are not moving away from it. Do we understand?
Okay, sir.
Do we understand? I want to ensure we understand. Ruth.
Yes, I'm with you, sir.
Do you understand? I want to ensure we understand.
Yes, but
Okay.
I still have issue with it, but I'm still not getting it very well.
Okay, so let me trash it out.
It's a related party transaction is based on the percentage of shares that each
organization have in themselves.
Organization has. So irrespective of the percentage of shares, that both any transaction that happens is a related party transaction. Is that what you're trying to say, sir?
No. So let me thank you, because you asked those questions and you need to ask it so that we'll be on the same page and understand. And I want to believe that too. Even some people that are not asking, we have the same similar. So what I'm saying is this: when we are talking about related party transaction, the real risk in that is that transaction may not be at arm's length. Ruth, yes or no? So I need to carry you along.
Sir.
So don't mute now. Let us. So the risk in related party transaction is that transaction may not be conducted the way they should be. So that one established. So to take the risk away now, we need to audit it. And based on our standard and the like, the director's supposed to give us like the list of their related parties. Party A, Party B, Party C, Party D. But even though we're supposed to have that document, number one, we may not be able to get it on time as our when due. We may not be able to, there may not be full disclosure as is expected from the management. And the truth of the matter is this: don't forget that all those transactions, related party transaction and the like, they can become significant and tax may be on them and the like, a lot of other governmental procedure. So it's possible because client management know that auditor will audit and put everything the way it's supposed to be. So it's possible that they did not fully disclose to us. But now it's our responsibility to ensure that we dig deep into it. And the best way and the way that we will not get it wrong is to follow the influence in the transactions. Who influences what? And if we are to follow it, we cannot, how will I put it? We cannot only say based on percentage contribution or interest in our clients, because it's possible for some organization to have greater interest in our clients basically because of profitability. They have the shareholding, but profitability will only come from, let's say, sales. So let's say we now have another related party that's, let's say, 5% interest in our clients, but the major sales, major transactions actually are coming from them. If we approach it based on 20%, 5%, we may miss out on that influence on that particular related party, which is actually significant, but they are misrepresented by virtue of their shareholding. So we should not limit ourselves. What I'm emphasizing is we should not limit ourselves as auditor to shareholding or share contribution ownership in our clients alone. We should look for who influences what. Like if for any reason that organization with 5% should leave our clients, the sales per annum is going to drop drastically. Do you agree?
Yes.
So, and when it does happen, it becomes a going concern for our clients. So as auditor, if our client will have going concern issue, we should know. And it will follow by the percentage and the like. We may not be able to track it, but it will follow who is influencing, who is waging real influence on different transaction or different relationship in our client's business. What I'm emphasizing is with that, we cannot go wrong. By experience, we cannot go wrong. And that is what I'm advising us. So I'm not saying we should base it on influence because there's a standard. But what I'm saying is the exam question is going to come with trick, but it will follow influence in that question. We can't get it wrong. That is what I'm emphasizing. Is it clear now? Is it clear now?
Yes, sir.
Okay.
Yes, sir.
Okay. So let us move on to the next subtopic, which is refusal to provide presentation. That is, after we've asked our clients to provide us with management representation letter and they could not provide us with management representation letter, what should we do? And what does that suggest to us as auditor? I'm trying to scroll I hope to find that aspect, but if not, I will just treat it. Okay, it should be somewhere around here. So I want to believe, okay, yeah, of course, we know what letter of representation means, management representation letter and the like. So when they refuse us, when we ask for it, I remember the last time that we treated it, I told us that management representation letter, actually, we could divide it into two. Do we still remember? Can we quickly contribute? If not, I quickly trash it. I'm waiting to hear us. I'm waiting to hear us. Are we together? I want to hear us.
We are together, sir.
Okay. So I said last time that we treated representation letter, I mentioned that we could divide it into two, or it comes in two forms. Can we quickly mention it? I want to believe you will know. I want to know whether we remember it or I should start from there. Okay, let me start from there. So holistically, let me tell us what management representation letter is and like. So when we started, we spoke about assertions, and I told us that assertions are assurances from management to us, and those assurances will be in letter and correspondence between themselves and us as auditor. And that medium is called letter of management representation. And please note, in exams, they will not, most likely they will not ask us what is management representation letter. They will only say what is maybe written representation or letter of representation or representation letter. Deliberately, they will remove that management. Deliberately, they will remove that management so that probably, I wouldn't know. So, but please let us know that what management representation letter is the same that they call those different names. Is the same, please. So we should lay that to heart. Okay, so now it's possible. So it's divided into two. Management can represent to us on the general level or generic management letter of representation. And the general management letter of representation actually is the one that we have assertions in it. The generic management representation letter is the one that we have all those assertions that we've mentioned on it. But we are going to have other letter of from management too, that is correspondences in the course of our audit. And those ones, we can call them specific letter of representation. And those specific letter of representation will not have assertions in them, because that generic always will come at the onset, that is at the beginning of our audit procedure. They are assuring us that the general ledger given to us, trial balance given to us, and the financials given to us is complete, accurate, obligation properly classified, existence, cut-off procedure, or cut-off period rather, and the like. But as we continue to audit, we will need to ask them to write us what they know about some aspects of their business. So when we ask for a specific correspondence, that is, let's say, for example, we ask them about a creditor, or a bank balance or an overdraft or any other observation in which we do not want them only to discuss with us in a meeting or verbatim. We want them to write, put it down in black and white. So those letters, those documents are part of management representation to us, but they are specific because in them, the management is going to go straight to the point and address the issue or the concern we've raised. They are not going to assert outside that question that we've raised, because the first correspondence or the first assertion in the management representation letter will detail all those assurances that should be in the generic representation letter. So every other one that we request based on our request and they return to us, they are specific management representation letter. So all of them are representation letter, but I'm only pointing our attention to it that from the onset, we are going to receive management representation letter, and those items that will be in it, they are generic. They are generic items or generic discussion. Meanwhile, as we continue to audit, we are going to have specific letter of management representation. Like here, if we look at the screen now, example of letter of representation. So here now is a generic letter of representation, and all we see in it is about the assertions. You see the financial statement, significant assumption, related party, all events, information provided. So you see, they are basically on the assertion level that we discussed. So, but after this, we are going to have some series of discussions with them, and we will ask them to provide answers in writing. So those ones are specific, and they will only answer the question we've asked them, not going into the generic. So now, refusal to provide us requests. So now we are talking, this request we are actually talking about now borders on the specific written representation from the management. Don't forget, from onset, we will have collected the management letter of representation on the generic level. So if we ask our client's management to tell us what they know about some aspects of their business and they were not able to tell us, as auditor, it puts us on inquiry. What do we mean by put on inquiry? That is, it makes us to ask question, why? Why are they not telling us what they know about the question we've raised? Is it that they do not believe that it's important? Is it that something is much important in the transaction or in the question we've asked, but they do not want to disclose it? So those are put on inquiry issues. So when they refuse, the first thing that we should do is to enlighten them. To enlighten them, let them know the importance of our request, and that every request that auditor may must be responded to by virtue of legality. They should respond to our queries, especially when we ask them to put it in black and white. So after we had the discussion with them and enlighten them that query we raise is important, they answer us and they answer us on time, and maybe yet they are not answering, we ask ourselves, having discussed with them and letting them know the importance of that particular question or query, audit query or observation, why are they still not answering us? So the next step is we should then reevaluate the integrity of our client's management. We should reevaluate their integrity. See that they are hiding something from us. You see that we've approached their work wrongly. You see that there are some things we need to put into plan or execute more. So we need to ask ourselves some fundamental questions. Why are they not corresponding? Why are they not answering the question? So we need to reevaluate our work done, reevaluate our audit approach, reevaluate those evidence that we've collected or gathered even before that time. Then, having done that, having looked within our audit team and within our audit system and approach, then we should take appropriate action. And part of our appropriate action could be that we may need actually to disclaim or to qualify generally the audit report. We may need to qualify our opinion. It may go to that critical extent that we need to qualify our opinion about their organization and the financial statement that they presented to us. So let me hear from us before we move to another subtopic to ensure that we are on the same page and we are being carried along. Class, are we together?
Yes, sir.
Okay. Any questions on this refusal to provide representation or on management representation letter generally?
Yes, sir.
Okay.
I think I would like to ask, since we are are you saying once there's a third-party relationship? I just want to summarize my understanding of what you said. Since that if there's a third-party relationship, if there's a third-party relationship that looks like we have an issue on, then we raise, we request for a specific management representation letter, right? Which is different from the initial management representation letter that we obtained at the beginning of the audit. And that if we do not get any good response from them, then that should lead to probably disqualification or that should disclaimer opinion or qualify the audit report. I just want to.
The answer to your question actually is yes, but we are actually coming from the background of not the related party alone, even though we've treated the related party. But that observation that or audit query that we raise does not necessarily need to be from the point of view of related party. It could be any other area of their business. Any question that we raise must be responded to. And if they are not responding to it, then it puts us on inquiry. Then we need to carry out the series of steps to ensure ourselves that we do not express our opinion wrongly. So the answer to your question is yes, but make it broader. Don't look at it from related party alone, because we've moved on from related party to general audit. So any audit query raised that did not respond to, we fall under refusal to provide written presentation. So let me hear from you. Is that clarity now?
Yes, sir. Yes, sir.
Okay. Okay. So we can move on. So let us move on to assessing the need of an expert. Assessing the need of an expert. I know we've introduced ourselves then to who an expert is, but now we want to address how can we assess their work and how can we assess that we actually need them. So now before I move on, class, I want to ensure that we still remember and understand who an expert is. So I would like somebody to tell us what he or she knows about an expert. Who is an expert?
Let me try, sir. An expert.
Okay.
An expert.
An expert.
You said an expert is a person that has a specialized knowledge,
Okay.
and belongs to a particular body of knowledge.
Okay.
After which you must have gone through a certain curriculum or training or something. I don't know. I can't really put it together. I'm just trying to remember. What did you assist me?
Okay. So who will take it from where you stop? Who will take it from where you stop? Oh.
Hello, sir.
Yes, so we are together.
Okay, as said by Farouk, an expert is a person who has passed through a body of knowledge and is experienced in that field, but not in auditing and accounting field, related field, outside auditing and accounting field. So that person is an expert that is in a body of knowledge and experienced in that field.
Okay. So I clap for us. That is good. So now, how can we assess that we need an expert? Assessing the need for an expert. Don't forget, then when we were treating it, I let us know that before we can engage an expert, because we are not the one paying for the expert, we need to carry our clients along that we will need an expert. And of course, it comes naturally. If somebody is going to pay for something, they want to ensure that that person's contribution or work or goods or services actually we have positive influence on their work or what they want to achieve. So we must be able to sell the expert contribution to our audit generally to them. So for us to sell it to them and for them to buy it, that is for them to be ready to pay, which we are going to include in our fee, we must answer all these critical questions. So that brings us now to types of an expert. And when we are talking about experts, it's either basically is management experts or our experts or auditors experts. And basically the difference is in who engage who. So if the management of our clients engage the professional or the expert, then it becomes the management expert. But if we are the one that engage them to carry out an aspect or an assignment within our assignment for us, it becomes our auditor's expert. So what are the critical questions that we must answer when we are assessing whether we need to engage them or not? Risk. We must ask, so if we do not use the experts, what risk of misstatement is in our audit, or can we experience? It would not allow them to contribute into our audit work. What risk of misstatement? What could go wrong? What could go wrong in our audit? So if we believe that it's significant, something significant could go wrong, then we may need to sell the idea to our clients that we need experts' opinion in some areas. Then we must be able to pinpoint which area that we need them. Also, before we go to our client and tell them we need to engage an expert, we must ensure that there is no alternative. There's no alternative source or sources of having that thing done. Let's say, for example, at year end, our client has stock, that is buying of shares, selling of shares in Nigerian stock exchange or in any part of the world. We do not need stockbroker service before we can know what stock sell or sold for as at year end last year. By buying even Google or buying any newspaper that we have the list of Nigeria stock exchange and market as at that year end, could have done the job without need to pay highly for a professional. So that is an alternative. So a newspaper could give us accurate information instead of using human being, because that professional, that stockbroker, will still need equally to consult some original documents. So if you can have other original documents, why not than engaging them to do that one for us? So we must ensure that there is no alternative or suitable alternative that could give us that valid answer or valid opinion. Then we can sell it to them, because it should not be something good that at the end of the day our client is telling us that why do you need to engage an expert? Why not just buy a newspaper and you get the information there? So we now look as if it's all about money. So as professional, we must ensure that we believe and we know that there is no suitable alternative to what we want to achieve. The nature of that particular maybe item too is important. What do we mean by the nature of it? Like, let's say property. We are not experienced valuer. We are not trained to be, because it's a field on its own. So by nature of property, we may need an estate valuer. We may need the work of surveyor as experts to be engaged. So we must consider the nature of the aspects of our audits that we are not knowledgeable in before we can sell it to our clients to engage them and pay for. How significant is that item too when we are talking about the financial of our clients? How significant would the misstatement be if we do not use or engage an expert? If it's not significant, if it's an item that we can, even if there is an error in it, cannot contribute significantly to erroneous opinion, then we can let it be and use our judgment. Then last but not the least, we can talk about how complex is that item. How complex is it? And when something becomes complex, it's better that we leave it for professional. Let me give us an example of complexity. Let's say we are to audit a pharmaceutical organization. It becomes complex because different drugs have different storage, different facility that they must use, in fact, a lot of complexity. And don't forget that pharmacy or pharmaceutical is a life or death industry. Nothing must go wrong. and life of human being is extremely precious. So as auditor, when we are working in such an industry, we must be very careful because of the complexity or complex nature of the industry. So if we are to maybe value maybe their drug or the components, and maybe they are trying to have a new drug into the market, to introduce it into the market and the like, and we are to value it and bring the amount into book and the like, we may need to critically just engage an expert, and they should give us opinion about it before we use it, because it's complex and it is highly precious to human life. So these are some of critical areas or critical questions that we must ask ourselves, assessing the need of whether we need to use an expert or not. So basically, we need to answer these questions by ourselves before we can now propose it to our clients to engage or not to engage. In fact, if we know that we don't need to engage, it doesn't worth mentioning, then we can just go on executing our audit plan. Okay, so that is that about that. So let me allow to hear us for like few seconds too, that we are on the same page before we continue. Class,
We are on the same page, sir.
okay, great. So let us move on to putting reliance on internal auditors' work. How does external auditor work with internal auditor and things around that, using the work of internal auditor? Basically, we should not forget that whether internal auditor, whether external auditor, all of us are accountants. We are coming from the same background, having common knowledge, having common education, being in the same profession. What is different between us now is to what extent as individuals specialized. That is basically what is different between us. Because as internal auditor, we do not really need to be certified or licensed to be an internal auditor. Even though some organizations will not employ less than that, but as internal auditor, we do not need to carry accountancy license to be an internal auditor. But to be an external auditor, the person must be certified, the person must be licensed. So what then is required when we are talking about internal auditor? Basically, for anybody to be an internal auditor, the person must understand business control. Basically, that is the requirement to be an internal auditor. The person must understand control, must understand system. And when we are talking about system, we are talking about interrelationship of different units within an organization and the working together of different units and subunits working together as a whole. That is a system. So when we are talking about different departments or functions, those are the parts of a system. So an internal auditor must be a system person, must be a control person. So once that person understands system, understands control, then he or she can serve as an internal auditor, except the organization requires that the person should be maybe a chartered accountant or the like. So that is on their own individual organization's policy. But when it comes to external audit, the person must be licensed, or the firm of accountants must be licensed before they can be external auditor. So, but our focus is using, okay, Bukumi, let us hear you first before we continue. I could see you raise your hand.
No, it's an error. It's an error, sir.
Okay. So let's continue. So our focus is using the work of internal auditor. Before we can, as external auditor now, let us position ourselves as external auditor now. For us now to use the work of our colleague, internal auditor in our client's office, we must ensure that the person is actually technically sound. We must ensure that the person is technically sound. Don't forget that I mentioned that it is not a criterion that the person should be licensed or a chartered accountant. He or she may be, may not, unless the policy of the organization actually express that. But the person must be technically sound. So that is, the person must know the job. The person must know the job. You know, it's possible for somebody to know the job, but not certificated. It's very possible. In fact, majority of the time, many people know how to do some things, but they've, by one reason or the other, for one reason or the other, might have not gone to formal school to obtain certificate for it. But they can even know even better than people that are graduates in it. So we must ensure that that person has technical competence when it comes to business system or seeing an organization as a system and business control. If the person is technically sound, maybe we ask some question about his or her training, and maybe the person, the internal auditor is or has worked in an audit firm and almost qualified, or maybe qualified as the case may be. The person knows what he or she is doing, what it takes to be an internal auditor, what internal auditor must do as an appraiser agent within an organization. If the person knows his or her work, fine. So that is what we need to establish before we can use or rely on his or her work. Then two, how is she or he reporting? So the reporting aspect of his work. So we must be able to find evidence of work done. Reports, maybe quarterly, monthly, weekly reports. We must have evidence from his department as internal audit department. Where are the reports? And we must be able to go through the reports, verify the reports, and check the content. Then equally, we can validate the content. Like maybe there's an aspect that he or she has concluded that the internal control system there is working. So we can do a procedure on it and to establish and reestablish that, okay, his or her conclusion in the report is accurate. So if we test one or two or three of the reports and we find that they are actually established, then we can put reliance or more reliance on his or her work. But if we do the sample or sampling on the reports and we find the report wanting, then reliance, we may need to be very careful putting reliance on that internal auditor's work. Or it's objectivity too. How objective, how independent is that person? Because it's independence will affect his objective. So how independent is that person? We may need to ask some question, even some personal question before we can, or relate to some other key staff to know how independent that internal auditor is in the organization. Also, we could observe how relational is the person in the office, that is his relationship or ethics. How does he or she approach colleagues? How friendly and the like? You know, as auditor, we must be friendly. Not that we must not be friendly, because relationship must be built. But at the same time, there's a level of sociality that an auditor ordinarily will not be able to attend to by virtue of his work to maintain independence and the like. So if, for example, as external auditor, we observe the internal auditor in which we want to put reliance on his work to be a jester, that is somebody that just jests around, that's everybody there. Then we put a question on his objectivity or her objectivity, because anybody that will be objective as much as possible, but it has a minimal, we have a minimal effect on how objective the person, to what extent the person can be objective. Because somebody that you play too much with and the like, how are you going to correct, how are you going to write a negative report about that kind of person? And you believe it's going to fly. And if it does fly, will not backfire and things like that. So those aspects, as external auditor, we must review it before we can place reliance on the objectivity and independence, or use the work of internal auditor generally. How consistent is the report? See that he gives or she gives reports only about the finance and account departments. What of other departments? How robust is the reportage that the person has given? So all these, they are important questions that we must answer before we can use and rely on the work of our internal auditor, that is the internal auditor in the office of our clients. And also we should not forget, though it's a subtopic we are going to get to, but let me quickly mention it, that as internal auditor does not necessarily mean that that person is a staff. Internal auditor could be outsourced, or internal audit generally could be outsourced and could be localized. When we outsource it, it simply means maybe we engage the service of an audit firm, but they should be reviewing and appraising the system in our organization. So now they are not serving as external auditor. They are serving as internal auditor, but they are not on our payroll. They are like vendor to us. Or it's possible for us to localize it. That is, we have somebody that is technically sound in the area of systems and control. Then we put him or her on payroll, give him or her an office to use within our localized office. And the person is being paid monthly like every other staff. So that person is an internal auditor, but it's a localized internal auditor in the sense that it's a staff. So internal auditor could be a staff and could be non-staff. So let me pause there and hear from us as regards how we've fared and understand what we've discussed. So over to you, class, for a moment. We are almost through. I hope we are not tired. So part of what I want to hear from us now is how far are we doing where we are? Okay, class. I'm hearing us.
It's fine, sir.
Okay, that's Farouk. Any other person?
Yes, sir.
Ruth. Bukumi.
Yes, sir. With you, sir.
Okay. So let us quickly continue. I would like us to finish evidence today. So we will quickly go over audit sampling and audit of going concern. Audit of going concern now. So when we are talking about going concern, basically we are talking about what could go wrong in which we affect our clients drastically. Audit of accounting estimate too, but let us take going concern first, or I can be taking them together so that we can fast track things. I would like us as much as possible, maybe around 10, so that everybody can rest, because I know majority of us are going to work, even though me, I'm on my own. I know, so by 10, I would like to release us. So let's see how far we can quickly go. Okay, so audit of going concern is a procedure in which auditor concentrates on and asks questions and review aspects of the business that will affect or make the organization to actually go under. That is, not to be in existence again. And we'll see that it's a very critical audit aspect, because if the organization will not be in existence in the nearest future and we've audited it, what has been our contribution? If at all they will go under, have we informed them of some critical aspect of things that they need to deal with straight away? And before we can inform them or put in our audit observation, that means we must know too. Then how, as auditor, are we going to know when our clients even do not have information about it? So therefore, when we are auditing going concern, it is important to put emphasis on the narrative aspect more than on the figurative. What do I mean? As accountants, we audit figures. Give me balance sheets or statement of financial position. Give me this ledger. Give me that ledger. The truth of the matter is, as much as those aspects and those information, they are good and important, they may not be able to pinpoint or direct our attention to areas that could actually make the organization not to be in existence again. So therefore, we need to check documents, narrative documents, even outside financial and accounting system or accounting departments. Like, we need to check the minutes of board meeting. We need to check the minutes of the directors or the stakeholders or some other important meetings. We need to discuss with the secretary to the organization. I'm laughing. I'm actually laughing because the latest Finance Act 2020 is no longer mandating organization to have secretary of company. So, and that means there may be some critical information or a knowledgeable worker that we may not be able to work with henceforth. That may be some disadvantage to the new Finance Act, but we'll see how far we can go as a nation, as organizations, as practitioners, with the stipulation of the Finance Act that we recently have. So, but we need to ask, like, the legal department, who could be now be serving as the secretary of the organization. What are some experiences that they have? And all these things may not find their way into the financials yet. So if we concentrate on the accounts and account department, we may not be able to lay much of our hands on going concern issues. That is why when I started, I said we must pay attention to the narrative more than the figurative. That is, ask questions. We need to research. We need to Google. In the industry of our clients, what are people talking about? What are their customers? What are they saying? Customers review about their activities. These are going concern matters. And you see, satisfaction, customer satisfaction will not find its way in the accounts. By the time it will find its way in the accounts or in the accounts department, things have actually gone very bad. But as auditor, we need to know our clients. What are their customers? What are they saying about their products, about their services? The industry, do we have latest technology that will affect them, maybe in the nearest future, or that is already in vogue? We need to know, and we need to carry them along, because they may have now best of the products, they may be the industry leader, but for how long are they going to lead? Those are the questions that going concern audit must answer. And in approaching it, we must not limit our audit procedure to accounting balance, to general ledger alone, because those information may not be there. But in the minutes, in asking questions, in third-party confirmation or third-party correspondence generally, in research, in wide range of information on the internet, what is their customer? What are their customers saying, talking about them? What is in vogue? Is there any latest product that is could rival their products? We need to know all this and direct their attention using our management control reports. We are going to get a report to let them know that these are observations and that they need to act fast, so that their case will not be like the case of, say, the case of Nokia, that they have a very good product then, best in the world, strong phones and the like, but internet come to overtake them and they did not respond on time. And because they could not respond on time, because a going concern, people want phones that's internet compliant. Just imagine where you are now, you could not connect. You have the best of phone, but it's not IT compliance. It's not could not connect on the internet. You ask yourself the question, it's as if we are living at the back end of the world and we've purchased it. So people are not ready to live at the back of the world with their money they've expended. So therefore, people moved on, and today we cannot find Nokia, even though their products were good, their services were good, but simply because going concern were not properly reported or audited, and the world actually left them behind. So this is audit of going concern. So audit of estimate. Estimate generally, as accountants, we are figurative people, but as much as we are figurative people, there are some things in our financials that must be estimated. Like, we are not sure to what extent will be the recoverability of the debtors. So doubtful debt will arise, so we must make provision. So provision for doubtful debt becomes an estimate. Inventory obsolescence. We do not know when our product will become obsolete. And please, I want to believe that we know there is difference between obsolescence and expiry. When something becomes obsolete, that does not mean that that thing has expired. So obsolete simply means that item could still be good, but the word has moved on. That's what it means. The word is no longer in vogue. People are no longer buying it. Like Nokia now is obsolete. That does not mean that it has expired. It's just that it's not that relevant again. But when it expires, it means that the content now is maybe dangerous to health. So it has expired. So Our inventory obsolescence, we must estimate it. Are there new things in vogue now? So if there are new things in vogue or products in vogue, we must estimate our liability towards it. Warranty, if we have organization or clients that issue out warranty, we must estimate it because we are not sure. So all these aspects, we are not sure, like we are depreciating. We cannot really say that this is accurately what we've used up from in our assets purchased. So we just have to estimate it. So how are we going to audit and estimate? How are we going to audit our estimates? Basically, the judgment of auditor is actually required. We must be able to judge correctly, having wide experience. Also, we must ask some series of questions. Okay, Oga Accountant, having given us this provision, how did you come about it? What were your assumptions, underlying assumptions before you say, okay, this debtor may become bad and the like, and it's okay, this product or this organization actually has been taken over by maybe another organization and the like. Oh, okay. So we see that the recoverability is in question. So we must ask them questions. We must use our judgment too. Then we must ensure as auditor that, like estimate of depreciation, that the accounting policy is maintained. That is, there is consistent in whatsoever depreciation method they decided to use. They must continue to use it. In no wise would they not use it, because there must be consistent. If not, the audit of estimates, it becomes an issue if there's no consistency in the application of policies. That is, where policies affect the aspects of estimates, like depreciation. There may not be an organizational policy for provision for bad debt. There may not be for warranty, but for like depreciation, there will be. And as auditor, we must ensure that the estimate of provision for depreciation is consistent over the year. So that is that about audit of going concern and audit of an estimate. I'm trying to bring everything to close so that we can go and rest. So audit documentation. We are going to summarize it because we treated it in class. The current year file, permanent year file, the content of what should be in the file. I think we should just discuss it so I will know where to come in. I think, please, let's unmute and discuss it so I can know to what extent we understand it. Please, let us unmute and contribute to audit documentation. Permanent year file, current year file. Who owns the working paper? Who owns the custody? I know we've discussed this in class, so let's quickly discuss it so that we can move on. We are rounding up already, but I want us to finish evidence. Okay, who is speaking? Hello, Ruth, you want to say something?
The audit firm owns the working paper.
Okay.
So, and it's always in the custody of the audit firm.
Okay. Okay.
Of the auditor. So until when there is need for changing. Okay. Until when there is need for changing of audit in the auditor firm.
Okay. I think we should rest for today because it's almost 10 or 10 already, depending on which clock we are using. And I would like to release us so that we can go and rest. Then we will continue from audit sampling and the like. Then that will be the end of audit evidence. Then we go into evaluation. But before we go, I want us to agree when should we meet again, because we still have a few of topics to deal with. And now that we've agreed that we should basically do everything online, let us contribute to when should we meet again. So let us discuss that before we call it a day.